Technical analysis can be as simple or as difficult as you want to make it. Today we are going to discuss the way that I analyze supply and demand zones in these financial markets. If you are new, welcome. If not, welcome back. So most of my subscribers and the CTM community know these levels best as Heath levels, a term derived from the early onset of the community. So what is supply and demand? It is an actual phenomenon that occurs in the chart for a specific reason, usually at turning points in price. This occurs when price is moving one way then reverses. When this reversal occurs, there is a place on the chart that lets us know. It's usually the last candle before the turn in price. The theory behind this is simple. If price is going lower, then the next day starts to go back up, then we know that on the last red day, more people are buying than selling because the next day changed direction. This is also known as exhaustion. The selling or supply was exhausted by the demand or buyers. So we watch these turning points for possible entries in the future. In this example, you can see prices falling when met by demand. If price is falling rapidly, then you already know there is a lot of supply in this asset, aka sellers, because price is falling. To see this in the chart, you are looking for a spot in the specific time frame you are observing to reverse. The reason for this is because the supply or demand changes, no matter how briefly. In a selling example, or when the red candles are forming and consistently opening and closing with lower highs and lower lows, price will continue to fall until it meets enough demand. Once that demand, in the form of buy orders, start to stack up, only then can price stop and change. The candles went from red to green. This does mean that the buyers were there, no matter how briefly this takes place. Now, if this candle closes green, but then the selling resumes, it means the sellers are still more aggressive than the buyers and price resumes back to the near-term trend, moving lower, until the supply meets enough demand to make price trade sideways or consolidate. Now, all this is well and good, but how do we implement this into a trading strategy? The way that I do it is I follow the trend. This is a trend trading strategy. On a larger time frame, you are looking for a consistent trend. Since we use selling in the first example, let's stick with that. In a downtrend, we are looking for a place on the chart where the supply briefly met with enough demand to cause a pause in the price. This can be one or more green closed candles. The reason we are looking for this or these green closed candles or up closed candles is because we know there was enough demand at that price to cause price to stop going lower. In this example, Bitcoin on the daily chart is in a downtrend. As the sellers are in control of this asset, you are looking for the supply zone. Here you can see after a week or so of consolidation, the selling resumes because it has exhausted the demand. Here on the November 9th and 10th candles, you can see how more demand came back into the market, causing two up closed candles. This is likely profit taking instead of actual buyers. We know this because the selling resumed and took out both green candles lows and closed below them. So in the next few days, we will be looking for price to trade back up into the supply zone. It is a supply zone and not a demand zone because supply zones are above price and demand zones are always below price. So similar to resistance and support. As you can see on November 12th, price made its way back up into the supply zone and then the selling commenced. This is also where we are looking to enter new positions, looking for sell side continuation. I know that most videos about this subject will have you outline the entire candle's range as the zone, but in reality the actual zone should just be the up close candle's body. So you are watching the price at that candle's open. In this example, it just trades a bit higher than the previous day's open, but upon resumption back below the previous day is where you will be looking for that entry. Putting your stop above the wick high is a good spot to look to exit the trade by a forced stop loss, as we never know if the trade will work out or not. Over time, with enough experience, you will start to see this playing out over and over again, and that's when you will have the confidence to execute these trades. Now for demand zones, you are looking for bullish continuations. You are looking for exactly the same thing, just inverse than the previous examples. So let's bring our focus over here to December the 18th. The demand zone will be the open of the bearish candle because that's when demand outweighed supply. Once price trades away from the demand zone, you are looking for price to trade back into the demand candle's open. Once it trades back to the bearish candle's open, this is when you're looking for possible bullish entries. And you can see finally on the January 3rd, this happened. Once price hit the demand demand zone, you can see the bulls are now buying, and since there is more demand for this asset, it trades higher. On your trading journey, you will see, like everything else in trading, this will not happen every time. This is why it will be up to you, the individual, to make a set of rules and to stick by them until you can work out all the kinks in your trading plan. So while on this journey, you can help yourself by shaving some time off this by subscribing to this channel. Like I said earlier, this is a trend trading strategy. You are looking to enter trades in the direction of the trend at a supply or demand zone. One question will be, does this work on all assets? The answer is yes. Stocks, Forex, and crypto is what I trade on the regular basis, and I use this method on all three markets. The main reason why I only draw my supply and demand zones with a single line at the open of the supply or demand price is because I like to keep my charts neat. Also, this gives me a pinpoint accuracy when taking my trade entries, giving me the ability to have the smallest stop loss distance to increase position size, as I am mainly an intraday trader. Let's move on over to the Forex market and look at Euro USD. Both of these examples will be demand zones. I attached a single line to the open of the bearish candle to watch for possible bullish entries. You can see on the June 19th candle that this is the demand zone. Price was bullish. Once it put in this candle and traded away from this area, that made it a demand zone to look for the market to trade back into that area for entries. You can see how price attempted on multiple occasions to go lower and could not. This is the reason for the extended bullish trend you got for weeks to come. The second example on the July 16th candle, you can see that 2 days later price traded back into the demand zone and briefly left the area. For me, this has been the best way to analyze supply and demand. As far as support and resistance goes, I use it as well, but also much differently than most other traders that you will find on social media. For resistance, or a level of price above current price, you are looking for daily bullish closes. A bullish day's close will act as resistance until you get another bullish close above that area. Then you will have a new resistance, and that looks like this. On the April 14th candle, you put in a resistance that held until it was broken with another bullish close. You traded back into the resistance on May the 1st but closed back below it, so on this attempt it failed. And again on May the 20th, you traded up above the resistance, but again to no avail. This resistance was finally broken on May the 26th with a daily close above. So at this point, you are looking for this level to possibly hold as support for bullish continuation. So that original price that held as resistance was an objective level of resistance. And for your objective level of supports, it's exactly the opposite. You are looking for the lowest bearish close. Here is a brief example on June the 25th that you can see a bearish close held price as support for multiple days, with price failing to close below that price. That is objective support. Also, demand outweighed supply and price aggregated higher. The most common question I am asked about my strategy is, why do you sometimes have a line on both the open and the close on a specific candle? My answer to you is a supply or demand zone can also be support or resistance. The two things are very different though, and the reason is, for supply and demand, I'm usually watching for the open of a specific candle, and for the resistance or support, I'm looking at the closes. Here is a perfect example of this. This one lonely bearish candle is both demand as well as support, the open being demand, the close being support. Now this occurrence will not always happen, but if it does, it's two good prices to watch for trend continuation. You can see the open as demand, and it was strong demand, so you never got a test of support. So I understand that it is a bit confusing, but hopefully with this video I am able to clear up this confusion for you guys. Once again, if you want to learn more about this, then go ahead and hit the subscribe button. Also hit the bell notification so you get notified when I go live or upload a vid. If you like the vid, please smash the like button. Thank you so much for your time. Make sure you trade safe, trade smart, and happy trading, everybody.